So, hello everyone, a very warm welcome to all of you on the new YouTube channel of the Ecoholics, specifically to cater the aspirants of RBI Grade A and Grade B 2025 and the future examination of RBIs. Now, as the name of the today's topic, you people must have seen that today we will be discussing. Okay, so today we will be discussing the RBI bi-monthly monetary policy review statement that got released in the August 2025. Okay, this is what we will be seeing it today. And why this particular topic is important? So obvious thing is that this is the fundamental and the most basic document that RBI releases, that not only decide the present scenario of Indian economy but also set a tone of the government or of the RBI for the upcoming scenarios of our Indian economy. So this is a one reason that it is important. Or it is, you can say it is an extremely important document. But now, if you see it from the ambit of syllabus, then over there as well, they have clearly mentioned it that the monetary policy committee and its bi-monthly review statements are important. So from the syllabus as well, it is quite clear. Now, if you see from the previous year questions analysis, so over there you can see that in a phase one examination, it is quite evident that they can ask any number of questions. Okay? They can ask the MSF rate or SDF rate or repo rate, or even they can ask the real GDP projection of RBI. So RBI also releases this data in its, you can say, in its review. So these kind of numerical data they can ask, even not in the RBI examination. Even if you talks about any other regulatory body examination, let it be NABARD or PFRDA or EDI or any kind of insurance or banking sector examination, bi-monthly monetary policy review data is something that can anyone frame any kind of question. Okay? Basically from the factual data and even from the study data as well. Now, coming back to our discussion, sir, what is the scope of this document from the perspective of phase 2? So, in phase 2, if you see, I think in the year 2021, there was a direct question in a descriptive part of the paper 1, that is economic and social issues. Over there was a direct question on the various direct and indirect tools of monetary policy or monetary policy committee, or whatever the direct and indirect tools RBI is having to implement its monitoring policy, to make it effective, to make effective its monetary policy. So all these kind of documents. So there was a direct question in the paper 1, that is ESI, in the year 2021, I think, or 2022. Okay? So this is the scope from the perspective of mains examination. Now, even in the interview, if you are attending an interview for a RBI grade B profile or grade A profile, so it is quite evident. It's something that anyone can guess, that they can ask the basic data and what is the mandate of RBI in the present monetary policy review, bi-monthly review. Okay? So this is the kind of data you can easily expect, you can easily get an idea कि ये चीजें तो पूछी जा ही सकती हैं. And specifically in context of, if someone is asking about some government scheme and reports, then we can say that these are the important things or these are the not. But when we talk about the RBI monetary policy statement and all these kind of document, then it is quite evident. It is nothing that I will tell that this is the important document. No, you can also have an idea that ये ऐसे documents हैं that is going to be important. There is no if and but. Okay, so now let's proceed with our discussion. So first we will discuss some static component of the monetary policy framework, what is monetary policy committee, and then at last we will see that what was the RBI's monetary policy, what is going to be the RBI monetary policies data that they have released in this bi-monthly review. Okay, just wait. Let me present my screen to you people and then we'll go ahead. Yes, Tanish, I will cater your query once we will be done. So in the end of the session, we will cater with your query. Don't worry. Okay, so I think the screen must be visible to you people now. Okay, so now let's move ahead with our discussion of the day. Now, what is monetary policy? Okay. From last few minutes, I am telling everything about monetary policy, that why it is important, what is the importance of this document from the perspective of different levels of the examination. But what is monetary policy? So now this policy refers to a process by which RBI regulate the supply of money and credit in the economy. Okay. Now, whatever the reason may be, might be to control the inflation, might be to check the to see the economic growth while regulating the price level of the commodities or the prices of loans or etc. So whatever the reason may be, but basically this policy is a process via which RBI regulate the supply of money and credit in the economy, and then after doing this, there can be n kind of reasons or n kind of implications that RBI might be seeing, that okay, by controlling the supply of money or credit, we will be reducing the inflation, we will be maintaining the economic growth. So whatever the reason may be, but the basic fundamental behind this is to regulate the supply of money and credit in the economy. This is the basic reason why RBI frames monetary policy. Now, this provision of policy framework is governed by the RBI Act 1934. Now, what is a major objective? So, there are some primary objectives, that is the price stability, and then the secondary objectives. Okay? Now, this price stability and economic growth, if you see this price stability and economic growth is also there in the preamble of the RBI. Okay? So whenever you see the main statement or the major statement of the RBI monetary policy framework, so in that framework, that is, it is there in their preamble that the basic reason behind the monetary policy and its implementation is to maintain the generic level of prices, it means price stability, and then at the same time targeting the economic growth. So these are the two basic terms that you will be finding in the preamble of RBI. Okay, so whenever if this kind of MCQs occurs, that what are these two words, what are the two words that is there in the preamble of RBI, so you can guess that price stability and maintaining the prices of the commodity or the economy, that is the price stability, while concerning the economic growth. These are the two words that is extremely important when we'll talk about the objective of the monetary policy. Now, the first primary objective, that is price stability. So focus on controlling inflation through inflation targeting. We know current target is, so what is the, now the first primary objective we saw that it is the inflation targeting. So in that 2016, when the RBI Act 1934 got amended, and when the monetary policy framework came in picture, so that time RBI and Government of India collaborated. It will take hardly 30 minutes, 30 to 35 minutes, hardly it will take. Okay? Now, so yes, coming back to our discussion. So when the in the 2016, when this the between the RBI and the Government of India, when they collaborated, and then when this RBI Act 1934 got amended to implement the monetary policy framework. Okay? So at that time, what happened? They decided that okay, this is a monetary policy we will be having. Then there should be a target. So whenever we do any task, even if we are studying, so we set target for a day, target for a week, target for upcoming year. Okay? So on the same note, RBI and Government of India decided that we will target to keep our inflation in a specific bracket, and we call it inflation targeting. Now, for inflation, measurement of inflation, we have many. Okay, just wait. Am I audible to you now? Now, moving ahead. So, if you see the so that is this is what they decided, that they will be having a specific bracket. Okay, a specific bracket they will be having with the inflation targeting. Now, in India, if you see, to measure the inflation, we have multiple indexes. For rural, we have different. For urban, we have different. On a combined level, we have different. For consumer, we have consumer price index that is there for retail sector. For wholesale sector we have wholesale price index. Okay. For industrial sector we have a different indexes. So but what they decided that they will be targeting the inflation while keeping in mind the consumer price index combined. Now, we have a CPI for rural, we have a CPI for urban, but we have a CPI combined as well, that is rural plus urban. So, if any question arises that in the inflation target, what is the index that we cater? So, the answer is going to be CPI, Consumer Price Index combined. So, this is something the index that we consider while targeting our inflation. Now, what is the target? If you see, the target is 4%, 4% CPI, okay? And then you can say the tolerance band is plus minus 2%. And that's why you can see over here that we have written 2 to 6%. So this is the entire band that we were talking about. But the target is 4%, and we will be tolerating minus 2% and the plus 2%. And this is how a proper, you can say, a band is going to get created, that is plus between 2% to 6%, but the targeting is 4%. Okay. Now this got decided in collaboration with Government of India and RBI after each 5 years. Okay. After every 5 years this inflation targeting get decided. Now the secondary objective is to support economic growth, employment generation, and exchange rate stability. So these were the basic fundamental of the monetary policy. Now, what is the monetary policy framework? Okay. We just talk about, we just had a discussion that what is monetary policy. Okay. Now, what is the monetary policy framework? So, this framework that we see in our country, okay, at this point of time, it came in existence in the year 2016 when RBI Act got amended to formally provide a legislative mandate for the RBIs to implement the country's monetary policy framework. So earlier to this as well, RBI was the only organization who was maintaining the monetary policy, but there was no legislative mandate. So if you see over here the word that they have written the formally. So in the year 2016, the amendment happened, and then formally they provided a legislative mandate to RBI to implement the country's monetary policy framework. Objective was to determine the policy repo rate and to manage the liquidity condition. So these two basic was the objectives. Now, so under this framework, there were multiple tools as well, instruments as well that RBI utilizes under its monetary policy framework to execute its monetary policy decisions. For an example, if they have kept the repo rate at 5% and then they changed this to 6%, then how they will be implementing, how they will be channelizing the repo rate from 5% to 6%, how this change will get reflected in the economy, how it will get passed on in the economy. So repo rate, standing deposit facility, marginal standing facilities, main liquidity management tools, reserve repo rate, bank rate, cash reserve ratio, statutory liquidity ratio, open market operation. These are the multiple instruments of the monetary policy framework that RBI utilizes. Now, moving ahead, we have the, so we saw that what is monetary policy. We saw what is monetary policy framework when it came in existence, but who make or who formulate the bi-monthly review, which is the, you can say, the responsible authority or a committee which makes a bi-monthly review statement that we saw in every 2 months. So this fundamental, you can say, task is vested with the monetary policy committee. Now this is an extremely important topic. Even if it is a static in nature, it is extremely important. Okay. Now monetary policy committee is a key decision making body of RBI that determines the stance of monetary policy, particularly the repo rate. This is the only policy rate established under the Section 45ZB of RBI Act 1934 amendment in the year 2016. So when the amendment of 2016 happened in the RBI Act 1934, that time this section got inserted in the RBI Act to provide a legitimate, you can say, legitimate uh, backing to the monetary policy framework. Okay. Now, role and functions, if you see, So it formulates the monetary policy direction based on the data and analysis provided by the RBI. It meets at least 4 times a year. Okay? It meets at least 4 times a year. Now, if you see, we have 12 months in a year, but for every 2 months, we have a bi-monthly monetary policy review. So if you see from this context, they are meeting at least 6 times in every 2 months. Okay? That's why it becomes a 12 month. So the minimum requirement is 4 times, but they meet at a time interval of every 2 months, and that's why they meet 6 times in a year. Now there are six. If you see if you'll ask me, sir, what is the strength of the monetary policy committee? So we will see that. Okay. So the strength of the monetary policy committee is 6, and out of 6, the quorum is 4. The minimum quorum is 4. It means whenever a committee meetings happen, to classify it as a legitimate meeting, okay, in official terms, the at least 4 members out of these 6 members should be there in that committee. Okay, this is what quorum means. Now, resolution passed by MPC are made public after each meeting. Minutes of meeting got published after the 14th day of the meet. Okay. Then RBI also publishes a monetary policy report that we saw. Okay. But this monetary policy report comes in every 6 months. So twice in a year. Twice in a year, RBI releases monetary policy report in a for every 6 months. It means twice in a year. In that report, that it talks about the source of inflation and the inflation forecast for the next 6 to 18 months. This is what the whole committee is all about. Now if you ask me the composition, okay, good afternoon everyone. So if you ask about the composition, then RBI governor, so it is a 6 member committee as I told you earlier. Okay. Now how it will get composed? So RBI governor is going to be the chairperson, ex officio chairperson by default, RBI governor. Then deputy governor is going to be a member of the committee, and deputy governor is the person who is going to be the charge of monetary policy. Then one officer of the RBI nominated by the central government. So if you see, out of 6, 3 comes from RBI and 3 comes from the central government, that we will see now. So 3 members appointed by the central government from among person of proven ability and expertise in economics, banking, finance, and monetary policy. So 3 people having the qualification to be there in a monetary policy committee. So these 3 comes from the RBI, and the lower 3 comes from the central government as an appointment. Okay? Now voting system. So each member has one vote. First of all, each member has one vote, and then in case of tie, for example, if there is a decision that they want to upgrade, they want to increase the repo rate, okay, but now 3 is in the against, now 3 is in the favor. So in this case of tie, the governor has a casting vote. The governor will decide, okay, governor is going to have another vote, and in whichever favor the governor will provide its vote, that particular side will take the lead. Okay, this is what the committee is all about, or the strength is all about. Now the major thing for which we are here, that monetary policy statement for the month of August 2025. So the repo rate, if you see the basic fundamental, what we saw in the previous slides, that the basic reason to formulate monetary policy, or the basic agenda behind formulating a monetary policy, is deciding the repo rate. So repo rate is, they have kept it at 5.5%. Okay? Then monetary policy stance, so they always keep their stance as well. Now these stances can be of 3 kinds. First of all, the first one is accommodative. It means RBI wants to inject money in the economy. There is a liquidity crunch in the market, and RBI wants to pump money in the market. Then they have the neutral stance. It means neither they want to pump money nor they want to squeeze money from the economy. Then they have the non-accommodative stance. It means they want to take money from the economy. They want to squeeze, they want to take back some money in the economy because of any reason. It might be the inflation or any such reason. So there are the 3 stances that RBI keeps in its monetary policy statements. It can be accommodative, it can be neutral, and it can be non-accommodative as well. But at this point of time, they have maintained their stance as a neutral. It means RBI is willing to adjust rate in either direction depending on the evolving economic condition. So they can be accommodative as well and non-accommodative as well. It depends on the evolving economic conditions. Now, so we saw the repo rate. Now the two basic fundamental rates that we should be in concern with is the SDF and the MSF. Now, standing deposit facility. So this is a very basic formula. Even if you don't want to remember this SDF and MSF, just remember the repo rate. Okay, repo rate. If you are remembering the repo rate, so just if you uh, subtract 2.5% from the repo rate, you will come to the SDF, and then if you add 2.5, okay, sorry, 2.25. Just wait. Okay, we'll see that. Then you will deal with the, just wait for a minute. So it is quite easy to remember. It is quite easy to remember just by subtracting 2.5 and adding 2.5. You can come across the real data of the SDF and the, just wait for a minute, let me open it. Okay, so just by subtracting a value and adding a value, you can have an idea of SDF and MSF. But what is this SDF and MSF? Now, repo rate is something. So before that, you must be knowing about the repo rate. So repo rate stands for repurchase rate. Repo rate is the interest rate on the basis of which banking entities, eligible regulated entities, take money from RBI. This is the basic knowledge each and everyone must be having. Okay, of you must be having. So this is the interest rate on the basis of which RBI lends to the banking institution or its regulated entities. Then SDF is also there and MSF is also there. Under MSF as well, RBI lends money to whom? To the regulated entity. Okay? In reverse repo rate, if you see, in reverse repo rate, what happens? RBI takes money. RBI takes loan from its financial institutions. Okay? And that's why RBI gives the interest rate to the some interest amount to its financial entity. Okay? So this is what the reverse repo rate is all about. Then if RBI is having a reverse repo rate, then why RBI, now under the reverse repo rate, RBI is taking money. So under the SDF as well, this standing deposit facility as well, it allows the regulated entity to park its surplus money with RBI and get some interest. Okay? But if repo rate and reverse repo rate is already there, what is the reason of having the SDF and MSF? So the reason behind it is that first of all, it's a temporary tools to provide funds to the regulated entity. First of all, repo rate and reverse repo rate are more elaborate and for a long term basis. Okay? But SDF and MSF are temporary and it caters only for a single day requirement, single day, 1 day operations. These are the 1 day operations. MSF and SDF is a 1 day operations. Okay? Under the SDF, the regulated entity can park their surplus money with RBI without having any collateral. So whenever we deposit any money, if I want to deposit any money with any one of you, then in return I must ask for any kind of collateral. So in case if you default, I gave you money and now you are defaulted it, in giving me back. So what I will be doing, so I must be having some collateral with me that I will ask to you so that I can get back my money back after selling those collateral. But in case of SDF, although regulated entity park their additional funds, their excessive funds, whatever they are having, they park this money to RBI to get some kind of interest rate, but RBI don't provide any kind of collateral. But in reverse repo rate as well, RBI takes money from the regulated entity, but in reverse repo case, RBI do provide collateral. Same goes for MSF. Under the MSF, they can take loan from RBI for a single day basis. Okay? When all the interbank money got dried up, or whenever these kind of financial crunches happens, liquidity crunches happens, they can get the loan under the MSF from the RBI. But The basic fundamental reason is that under the MSF, when the financial entity want to take loan from RBI, MSF requires to provide collateral. Under the SDF, there is no collateral, but under the MSF, we have the purpose of collateral. Okay? This is two basic fundamental that you must be remembering about SDF and MSF. Now, so SDF was 5.25% and MSF was 5.75%. Okay? So from here as well, you can have an idea that repo rate is 5.5%. Okay? If you add 0.25, okay, you will come across this 5.75. It means adding 250 basis point. If you add 250 basis point, you will come across the MSF, and if you subtract it, you will come across the SDF. Okay, now GDP. So let's talk about the GDP. So as I say, RBI also provides some kind of growth and inflation outlook as well in its monetary policy review. Okay, so in this case, if you see, as of so even in the many examination including RBI or any other regulatory body or any banking or insurance sector examination, this is one of the basic question, that what is the GDP growth, real GDP growth projection by RBI. So you can have an idea, you will get this data from its bi-monthly policy review. Okay, so the real GDP growth for the financial year 26 as per the RBI, it is going to be 6.5%. Real GDP growth for quarter one, 6.6%. Then the most important data, inflation. What is going to be the inflation for the upcoming financial year? So for the financial 26 that we are having at this point of time, as per the RBI projection, it is going to be 3.1%. So it is between our range 2% to 6%. And this is what our range were to target the inflation. So it is between our inflation targeting range only, that is 3.1%. So 6.5% is the real GDP projection for the financial year 26, and 3.1% is the inflation projection, CPI inflation projection as per the RBI for the financial year 26. So these are the two extremely important data that you must be remembering. But now the second major thing is, when you will see the real monetary policy review document, over there RBI always also provides the quarterly GDP projection and the quarterly retail inflation projection. Those data is not important for you. Okay? For each quarter 1, 2, 3, 4, and same goes for inflation. RBI releases the quarterly inflation projection and the GDP projection as well. Those data are not that much important, but even in case if your examination is in the third quarter or fourth quarter, so in whatever quarter your examination is going to be there, you can remember, you can go with the data for that particular quarter if you want to. Okay, if you want to, you can have an idea for that particular quarter, but not for each and every quarter. Okay, it is not an important thing. But the real GDP growth for entire financial year and the inflation, the targeting or the inflation expectation for the entire financial year is something important. Okay, so if you and so this is it for today's discussion. And if you want to download this document, you can download this document from visiting our app. You can download our app from Play Store, and you can get all these kind of valuable content from there free of cost. There is no cost for these data. You can get all the data from our app by visiting our app. If you want to have any kind of if you have any kind of queries in regard to the courses or the other paid content we have on our platform, you can contact on this number that is visible on your screen. You can take a screenshot, and you can contact on this number to get any kind of idea if you want to have in context of any paid content that we have. Okay, but all these kind of content that we have taking care of on this live session, you can download it for free of cost just by visiting our app. So do download it and do get these documents. So this is it for today's discussion. Thank you so much for joining today's live session, and I hope that you people must have got extremely valuable insight from these classes, this live session. And now we will meet tomorrow, and tomorrow most probably we'll be coming up with the one of the most important topic again. Okay, so it will get revealed tomorrow only. So stay tuned. Do subscribe our channel and do attend our live session. Now let me take some of your questions that you people have asked. Let me cater those things as well. Okay, so now RBI, just wait. Okay, so the question is, sir, RBI notification. So we are expecting the notification. 20th of August was the time, because if you see the 20th of July to 20th of September, this was the time frame uh, within which you can expect the notification. From 20th of July to 20th of September was the time frame we were expecting. If you see the previous year pattern, okay, so that was the time frame in which you can expect the notification. As of now, we are already on 20th of August. So although we have a 30 days in our hand till before 20th of September, 100% chances are that notification is going to be there. Okay. Now, if another question was that, sir, can you repeat the accommodative stance? Yes. Now see what I said. RBI, while having its monetary policy statement, or while deciding its monetary policy for the upcoming quarter or for upcoming 2 months, RBI can have three kind of stances. The first one is accommodative stance. It means RBI is saying is seeing that in economy there is a crunch of liquidity. So accommodative stance means RBI reduces its repo rate. So eventually, when RBI reduces the repo rates, banks take loan from RBI on a less interest rate, and then bank forward these loans to the general public. This is how RBI injects money via reducing the repo rate, and we call it accommodative stance of RBI. Now, the neutral stance means neither they want to increase the repo rate nor they want to decrease the repo rate. Okay, they will decide the variation seeing the evolving condition of the economy. Then we have the non-accommodative stance. It means RBI will be increasing repo rate so that the banks, it is going to be expensive for banks to take loan from RBI. Eventually, banks will also raise their interest rate for the general public loans, and this is how the money will get squeezed off, or the money flow will get regulated in the economy. So these are the three basic, you can say these are the three basic stances: accommodative, neutral, and non-accommodative. Okay. Sir, in this channel, you cover all the topics of the RBI Grade B. Not all the topics, obviously. For all the topics, you must be there in our paid courses. But yes, if any important topic is there that is important from the entire perspective of phase one, phase two, or interview, okay? If any topic is there is having this kind of holistic importance, then we will be coming up with those topic on these live sessions. Okay? Chalo. So thank you so much for joining today's live session, and now we will meet tomorrow with another exciting live session. So do join our live session to have amazing kind of content. So till then, have a great day ahead. Bye.